Hello dear friends, I am your host Rakesh, and in this video we are going to discuss a few do's and don'ts about the head and shoulder pattern that we have discussed in the previous video. In this particular video I will tell you what you need to do and what is prohibited in this pattern to be profitable.
But before we begin, let us have a look at the risk disclaimer.
It states that the futures, stocks and the options trading involve substantial amount of risk. Your capital is at risk, the losses can exceed the investment. The information is provided as is, and the user of the information assumes the entire risk of any use it may make or permit to be made. So let's get started. Okay friends, let us go ahead and have a look at a few do's and don'ts regarding to the head and shoulder pattern. As we have already discussed in the previous video, that head and shoulder pattern is a reversal pattern that is formed at the end of an uptrend, and it contains of two shoulders and a head. The first shoulder is called left shoulder and the second shoulder is called the right shoulder. In between there is a head which is easily identifiable because it is different from the other two highs. I will show you with an example, but before we go to start this video, I want to have a quick recap so that you all are with me in this video. In the recap, I just want to show that we have seen a head and shoulder pattern in the previous video, and that consisted of a prior trend. For a head and shoulder pattern to form, we need to have a trend, okay, like this. We should have an established trend, like this was an established trend here to here. How we can identify a trend? We can have a trend line, and then we will know that there was an established trend. Okay, now the second thing that we wanted was the need of a left shoulder. You see there was a high formed, and from there was a decline, and this decline did not go below this rising trend line. So this low was the first low, and the peak that it formed was the left shoulder. Then we got a need of high, and the rise from this decline, which was higher than the previous high, made the head. You can see this can be differentiated from the left shoulder in a very easy manner because it is much higher than the shoulder. So now we got the head also, and after that there is a need of the right shoulder. That right shoulder we have got when we got a decline from the head. Please notice how this head has the decline has dropped below this rising trend line. Now this is very essential in a correct head and shoulder pattern. If you can identify this thing, that the next low should close the pattern in such a manner that it should close below this rising trend line. Now you can see that it has put already the further rise in a jeopardy. Okay, now you cannot be sure whether the price will go higher or not because the rising trend line has already been broken. Okay, now this low may come approximately to the same low of the previous decline from the left shoulder, and after you get this low, you need to have another high which is called the right shoulder. Then you need a neckline. And how you are going to make a neckline? A neckline is made by joining these two declines from the left shoulder and from the head. When you join these lows, you get a neckline. Okay friends, it is very easy. And also you need a break of the neckline. Till the time neckline is not broken, this is not a head and shoulder pattern. Okay, we need a break of the neckline like this to be confirmed that this was a head and shoulder pattern. This pattern started from here, the formation started from here, but it was confirmed here when it broke. And also we need a retest of the support that has now turned into resistance. There is a possibility that the price will come down and go higher eventually. There is a very much possibility, but if we have to trade this, then the price need to test this support, and it should now act as a resistance and push the price down. That will be our entry at the retest of the neckline, and our stop loss will be slightly above this line here, and our take profit will be equal to the height of the pattern from here, which is approximately 1.5927 level here in this particular example. So this was a recap, and now we have see this stagger projection. We need to discuss some do's and don'ts in this lesson. Okay, first thing that you have to do is you have to look for a prior trend. I have already explained, if the prior trend is not existing, then there is no use of this in a head and shoulder pattern. Okay, it has no existence as such if there is no prior uptrend. Then you have to look for the left shoulder. You cannot be okay, I will draw and explain you. You cannot be looking something like this. Okay, you cannot be looking something like this and say that it is a head and shoulder. Of course it does not look like head and shoulder also, because there is no left shoulder here. Okay friends, you have to have a left shoulder also. You have to have a left shoulder, then you have to look for a head. Of course these are the classic ingredients. You have to have left shoulder, you have to have a right shoulder, you have to have a head. This is very, very important for the head and shoulder pattern. Then you have to join the declines from the left shoulder and the head to form the neckline. So whatever is the decline from the left shoulder, the lowest point, and whatever is the decline from the head, the lowest point of that, you have to join them and extend them to the right. Okay, you have to extend them to the right to form the neckline. Now this neckline may be sloping higher or it may be sloping lower. That depends upon what is the value of these two lows. Okay friends, and after joining the necklines, you have to wait for the neckline to break. These are the essential do's that you have to do. You have to wait for the price to break below this neckline. If you are say waiting for the days and months for this pattern, it is worth it to wait for the confirmation, because this neckline tend to be very strong support or resistance area. If the price reverses from here to the upside, there is a very high possibility that the price will keep going higher. So if you want the price to reverse, you wait for the confirmation candle to close below this neckline and go below, much lower, before it comes back to retest this support as the next resistance, and then you open a trade in the direction of the trend. Of course this was the end of the trend up, so now it is a beginning of the trend down. You have entered it at the first pullback. It should be a good news for you. You will have good profits if you mark it right, if you time it right. So wait for the candle to retest the turned support into resistance, and then you enter this market. Now these are the essential do's that you have to keep in mind. Now I will just list down a few don'ts that you have to keep in mind. You have not to anticipate the break of the neckline. Anticipation is something that you anticipate. If you don't understand, I will tell you it in layman's language. You cannot think that the neckline is going to break now and I will sell it. No my friend, you don't have to think, or you don't have to think in future that the neckline is going to break. You have to wait for the time till the time the neckline is not broken. It is a rule of thumb. You cannot enter the market straight away thinking that this will break today or tomorrow, so I will sell now. No my friend, you will burn your account in that way. So this is first don't, and the second is don't enter the market at the break. Now even if there is a break of the neckline, you don't have to enter the market. You have to wait for that broken support to turn into resistance. So your entry is here, not at the break. I hope you got my point. The third point is that don't be greedy. Okay, you got a good entry. Okay, you got a good entry here. The price is going down, down, down. There is a very high chance that the price will keep going down even after it takes this level. From here also it will keep going down, but you don't have to be greedy. You have your measured targets. These are equal to 1.5927. You book your profits at these levels. You don't have to wait for the price to go to the eternity, and you will wait for the eternity to book your profits. No, you just book your profits. And if from the history you see that there is some support coming before we achieve this target, I will suggest you to book profits at that support, because there is a possibility that the price after hitting that support level come back to the neckline. So my idea is that my friendly advice that rather than even looking for this target, you book the profit at the very next support that you are expecting that the price will reverse from there. Okay, so you book the profits at the very next support after you enter the market. That's all. Okay, I am done with this video of today. If you have any questions regarding my videos, you can write in the comment box, and you can approach me in my, you can go through my other videos which I have explained. If you have any questions regarding to my videos, you can ask me. I will be very happy to answer those questions. It is very good experience for me to explain these things in the videos, but if I get some questions from my viewers, that will be very good idea, so that I can explain them in my coming videos. That's all for today's video. See you in the next video. Thank you very much.